Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. After keeping interest rates at a 2-decade high for more than a year, the Fed finally decided to cut rates for the first time since 2020, cutting rates by 50 basis points. But that is not it. The Fed also sees two more 25 basis point cuts in 2024, 4 cuts in 2025, and 2 in 2026. Well, I have the perfect guest on to discuss the impact of the Fed's decision, what the impact will be on markets, and what are some of the signals that he is currently following, and what are they indicating. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Adam Thurgood. Adam is the managing partner at Hightower, Las Vegas. Adam, thank you so much for coming on the show. It's such an honor to have you on. And can you please tell us a little bit more about yourself in Hightower, Las Vegas?
Sure. First, thanks for having me on, Ryan. I always enjoy catching up. And a little bit about myself. Started in the business in 2000, so interesting time. You don't make money for clients for basically 3 straight years. And then my partners and I left our prior firm and started Hightower Las Vegas in 2012. So we've been operating as an independent firm for about 12 years. We're part of the larger Hightower network of companies, and we managed roughly $1.5, $1.6 billion for our clients on a discretionary basis.
Fantastic. Thanks for it. Yeah, you've seen a lot. That's about when I started too in the industry. I started in 2000, and it was chaos. You've seen so much from there. Then the great financial crisis, and it's interesting. You often talk about these newer investors that when they start investing, and it's only the good times. It's like, oh, this is so easy when markets are just up, and this is easy until we get like a pandemic or a great financial crisis. Then they're like, oh boy, things can go south really quickly.
Absolutely.
As I mentioned at the open, in a much anticipated move, the Fed finally cut rates, cutting by 50 basis points. What's your biggest takeaway from that Fed decision?
Well, there's obviously been a lot of hoopla around it. Every economist except for one of the major Wall Street firms was only predicting 25 basis points, but yet the market implied interest rate was suggesting that we were looking at about a 60% probability of a 50 basis point cut. So the market got it right. Now, from my perspective, I was a little surprised that they went 50, because essentially it's admitting that they made a mistake by not cutting in July at 25. So you have to wonder why they decided to go 50 this time around. And I've heard a lot of different input from a lot of different people over the past 24 hours about what's been the main driver of that, everything from it's politically motivated to the economy's falling off a cliff to, they're worried about the interest rate, I just lost my train of thought, the recycle of the debt that needs to occur next year due to all the maturities that are going to happen. And when you look at those in isolation, I think if you think about the politically motivated factor, they would have started cutting earlier if that was the case, because it does take time for those cuts to come through into meaningful economic activity. I think the bigger one is potentially that the economy is slowing, and they're a little more worried about what's happening with the economy than they're letting on. And obviously the refinancing activity that needs to occur in 2025 due to a large wall of debt that's maturing is certainly an issue. And maybe they're trying to get out in front of that. But if I had to pick one reason as the primary reason for why the Fed is cutting, they're probably a little more concerned about the economy than they're letting on.
Yep, I completely agree with that, Adam. I feel as if, 50 basis points, it's often said it's not maybe so much the direction of the cuts, or, are they hiking or cutting? It's the pace, right? And that's what we saw during the pandemic. It wasn't just 25 basis point cuts. It was very steep cutting to
Yeah.
try and save the economy. So now it's like 50 basis points seem like quite a bit for me. It's like, what does the Fed know that maybe we don't know, right? Is it really, is that labor market a lot weaker than what we think? Is there something, some rocky times ahead? Although in Powell's press conference, he seemed still pretty optimistic about and positive about the labor market. So I think it's wait to be seen there.
Yeah, on that front though, the Fed's not going to come out and ring the sirens and say, "Hey, we're really worried about the labor market, so we're cutting 50 basis points," because that just sends signals through the market that employers should be really worried about the labor market too. So
Yeah.
you're never going to see either on either extreme the Fed get uh, too transparent with what their messaging is.
You are spot on. It's kind of that fine line they walk right down the middle. They don't want to be too pessimistic or optimistic one way or the other,
Yeah,
and put different signals out there. But I and 50 basis points, like you said, the market was signaling 50, predicting 50, but it's also, 8 more cuts
yeah.
after this. So it's not, it's a steep, it's a cutting cycle we just started.
And the Fed is saying two this year, four next year. The market is saying 2.5 to 3 this year, and potentially 5 next year. So the market is pricing in more cuts than what the Fed is suggesting at this point in time.
Yeah, it's interesting. So, what impact does this rate cutting cycle and yesterday's, or last week's 50 basis point cut have on? Let's start with the bond market and yields. What impact does it have on yields?
Well, what we saw is that the back end of the yield curve actually go up, rates increased, and that makes sense to some degree because when the Fed is cutting rates, you should expect growth to reaccelerate, inflationary pressures to reaccelerate. And if the Fed's messaging is correct and there is actually no recession or growth slowdown that is a major worry, cutting rates by 50 basis points is going to cause inflationary pressures to rebound, growth to rebound. So it would make sense for the longer end of the yield curve to go up a bit. That steepening can be, positive for banks, but banks still hold a lot of long-term debt. So you wouldn't want to see the long end of the yield curve get lost here because of too much inflationary pressure, because that could counteract the positivity from their lending environment with the deterioration in the assets on the balance sheet.
Interesting. So, how about then on the equity side?
Equities is an interesting picture. Maybe let me take a step back. Right now, the bond market is pricing in 70+% chance of a recession with all these cuts. The equity market is pricing in less than a 10% chance.
Okay.
So those two are very different in terms of how they're viewing what's to come. Now, if we segregate that into two distinct scenarios and say, all right, what if the equity market is correct, or what if the bond market is correct? Let's start with the bond market. If the bond market is correct, obviously there's going to be a growth slowdown. Mm-hmm. Now, the equity market is pricing in double-digit earnings growth next year and into 26. And you're not going to see double-digit earnings growth if you have a weak economy and a recession. So if the bond market is correct, then you're going to see weakness in equity markets. Mm-hmm. Now, whether or not the bond indices rise in that environment depends on how weak the economy actually is. When we're already pricing in a 70% chance of recession in interest rates, in the interest rate market, you have to have those expectations or the reality be worse than the expectations for rates to come even lower to push bond prices up even more. Now, that's not to say you won't get your 4% yield, in the bond itself, but it's less certain how bullish it is for bonds if the bond market is right. You'd really need to see a dramatically weaker economy for the bond market to accelerate, substantially higher. Now, if the equity market is right, it's more clear. Rates have to go up. And if rates go up, it's bad for the bond market. Yeah. It should be good for cyclical equities if there's no recession and we get a cyclical rebound. However, interest rates going up also means discount rates go up, and that can be a bit of a drag on equities. And we saw that once the 10-year Treasury yield started to hit around 5%, equities always seem to pull back and not be able to withstand that type of pressure. So it depends also on the flip side. If the economy really accelerates from here and we do see double-digit earnings growth across the board and interest rates rise a lot, it may be a mixed bag for equities.
Mm-hmm. I'm really great information there, Adam. That was perfect. So, a lot of times in markets, or I should say investors, have really wanted cuts to happen for a year now. They wanted the Fed to cut rates. And, with the expectations that the Fed was going to cut rates, equities have done really well. They're, S&P 500's up nearly 20% this year. But with that being said, you got to be at times be careful what you're wishing for, and not just look at rate cuts in a vacuum, right? Being good for equities. And just like you said, you got to look broader and what's going on with the economy to determine really that's the bigger impact. What's going on with the economy, earnings moving forward to determine, where equity is going to go.
Yeah. And on that front, that's potentially why the Fed is cutting 50 basis points. When we look at our leading economic models that basically look at employment, production, consumption, and income, it's a weakening environment. Now, that's a leading basis. It's not what's happening now, but it's suggesting that tougher times are coming. And the Fed really focuses on inflation and the labor market. And our leading models of the labor market look pretty weak. When you look at like the jobs plentiful versus hard to find ratio, on a year-over-year basis, that's at recessionary levels. Full-time employment is now negative year over year. And one of our favorite measures to look at is the Kansas City Fed Labor Market Index, which is a compilation of a variety of different factors with respect to the employment market. And the 24-month moving average has been a pretty good indicator of where the economy is. When it's upward sloping, things tend to be pretty good. And when that turns to a downward sloping move, then you're usually close to recession or already in it. And now we have a downward sloping 24-month moving average on the KC Fed Labor Market Index. So there are some reasons to be worried on a leading basis of where employment's going. Consumption and production are more of a mixed bag. We've seen negative new orders, but we've also seen CapEx plans remain elevated. We've seen retail sales bumping around up and down. On an income basis, it's a little more dicey. We're starting to see some negative trends in some of the main leading metrics there. So if we put it all together, we can see a case for the economy weakening, and maybe the Fed is trying to get out in front of that and avoid the economy weakening too quickly.
I love that you brought up economic data in your signals, because that was where I was going. Perfect segue here. You talked about the labor market, and that's, the people I've talked to and read, they're hinting that maybe the labor market is going to soften, and that's why the Fed is going 50 basis point cut, because they're focusing more on the labor market and less on inflation. Think inflation is going to come down to 2.5%. So you have the labor market. You mentioned a few other data points that you watch. What can you add some more insight into those signals and maybe what they're telling you in granular, that maybe other people, investors, people aren't paying attention enough to?
Yeah, in terms of the labor market, you can think of it very simply as the hiring market and the firing market.
Oh, yeah.
And if you look at the hiring market, all of those indicators look like they're weakening and substantially weakening. On the firing side, we're not seeing it yet. We're not seeing mass layoffs. We're not seeing initial claims spike to 300,000 plus. So in a sense, we have recessionary hiring metrics and expansionary firing metrics. And you cannot get a deep recession unless you have the firing metrics falling. So one of the best things that any investor can do, if they're just trying to get a general read on what's happening with the economy, is just look at the non-farm payroll number or the household number that comes out once a month. If those numbers are negative, pretty good indication that we're in a bad spot, and vice versa. Now, when it comes to production and consumption and income, there are a lot more nuanced measures there. Typically, new orders is one of the better leading indicators, and there's the ISM Manufacturing New Orders Index comes out monthly, and it has a baseline of 50. So if it's above 50, that's expansionary. Below 50, it's contractionary. And new orders have been in the negative below 50 area for quite a while. Inventories are starting to increase, which tends to be a worrying sign. But on the flip side, small business confidence, CEO confidence remains elevated. You're just not seeing consistent economic data in either of those other metrics that are showing a clear trend. So you've got a mixed bag across the board, but leading employment looks to be substantially weakening, and I think that's probably where the Fed's focus is right now.
Interesting. So you have some conflicting data points on the economic side. Let's look at market signals. Like I said, equities, S&P 500 is up nearly 20%. And you mentioned it before, equities, they're not signaling and indicating a recession. What do you say? You put a 20% probability, 10% probability of equities, are indicating a recession. So they're, bullish, full steam ahead. So there's some conflicting numbers there just on the 30,000 foot view. What are some market signals that you follow, and what are those data points telling you?
Yeah, we have a variety of different models that we use to look at this. One of them is a sentiment model, and you can look at that at index by index. And it's essentially seeing if people are feeling good or bad about where they purchased their assets. And all of those indicators are still in positive sentiment. And what we've seen over time is that when markets are in positive sentiment, the risk-adjusted returns are much better than when they're in negative sentiment. You tend to have higher returns and less risk in positive sentiment, and vice versa. Okay. So from a sentiment perspective, people are feeling good about their portfolios, and there's not a rush to the exits. The major trends are in place. If you look at long-term moving averages and some of the main technical indicators, and then we look at what we would call our GIC model, growth, inflation, currency, and curve model. And I have to give a shout out to Charles Gav and Didier Darcier at GavCall, because their work really inspired us to figure those dynamics out. And what you want to see is a variety of countries across the globe experiencing positive growth dynamics and slowing inflation dynamics. Okay. And we look at that on a short-term basis versus a longer-term basis. And across the globe, there's consistency in that outcome. You're seeing a lot of positive growth dynamics and slowing inflation dynamics. And that's equity nirvana, more or less. So on that front, it's also very bullish for a risk-reward framework for equities. Mm-hmm. So we struggle because we're looking at the leading economic data saying, be very careful, but the market data is saying, go for it. And if we didn't have alternatives like T-bills that are yielding still 4.5% risk-free, it would be a much more challenging environment. But we do think that because of that alternative, you can have a little bit of dry powder on the sidelines that's giving you some yield while you try to figure out these conflicting market and economic signals.
That's right. I'm glad you brought that up, because it wasn't that long ago, before the Fed had their rate hiking cycle, that you didn't have that option. There were no alternatives, right, Tina? You didn't have that alternative of a 4% short-term yield. It was zero, right? So you had to go out in other places to get yield. So that brings up the point. And I love that you mentioned portfolio, building a portfolio kind of gives you an option, an alternative when you have short-term yields, giving you 4%. With the conflicting economic data, market signals, there's this uncertainty out there. We haven't even talked about the election. That's for a whole nother conversation. But how does that impact portfolio construction?
Well, I think just in general, you want to have well-diversified portfolios. Mm-hmm. And traditionally, people think of stocks, bonds when they think of that. And bonds were a great hedge to equities for a long period of time. We saw the exact opposite in 2022. And what most people don't realize is that gold has also been a great hedge to equities, and actually a better hedge to equities about 50% of the time. if you take a few steps back and think about that kind of on a first principles basis of why that would be the case, bonds tend to be a great hedge to equities when the currencies of the world are being protected and yield curves are steep, allowing for long rates to fall when bad times hit the equity market and the economy. That's not the state that we're in today. We're in the opposite state where currencies are being debased and yield curves are flat to inverted. That tends to be a great environment for gold to be a good hedge. So what we think of when we're trying to construct portfolios is a lot of different factors, but one of the main ones is how do we hedge our equity exposure? And right now we're overweight gold. We've been overweight gold as that hedging vehicle. There are all sorts of other nuances to portfolio construction. And you talked about at the very beginning of the podcast how a lot of investors have only seen one type of market. And if you have been investing for, call it 16 years, let's say 15 years, so 2009 till today, what you've seen is a dramatically outperforming U.S. large cap market.
Yeah.
And there have been periods where large cap U.S. equities have dramatically underperformed. I mean, all you have to do is go back a decade before that, from 1999 or 2000 until 2010, where the S&P 500 returned roughly, 0% for a 10-year period of time, where other asset classes did much better. So true diversification means that parts of your portfolio are not performing well while other parts are performing well. If you have a portfolio of everything that's ripping at the same time, you're not diversified. So you have to make the decision of whether you want to try and capture a trend and run with it, and be at risk of not having diversification, or if you want to have more stable performance over a longer period of time and have exposure to all sorts of asset classes, including commodities and precious metals and so on and so forth.
Yeah, that's a perfect way to explain the importance of diversification and portfolio construction. And it wasn't that long ago, 2022, when you had the 60-40 portfolio or whatever type of portfolio, if you didn't include alternatives or some type of hedge, you were down, because that correlation between equities and fixed income increased. Diversification, when you needed it most, wasn't there during periods of uncertainty. So I love that you brought up gold, because like you said, that is probably the most consistent hedge, or the truest hedge to equities there is, the best insurance play, because when it hits the fan, equity, that correlations increases, everyone's running to the exits.
Now, I will say that you need more bond exposure to hedge equities than you need gold exposure.
Oh.
Gold is a higher volatility asset, so you need less of it to hedge your equity exposure than you would need in bonds. So if you thought of like a 50-50 portfolio, stock bonds as perfectly hedged, you would need something like 25 or 30% gold and 70% equities if you wanted to hedge completely with gold. Now, we're not saying to do either of those things, but I just wanted to make sure people understand the dynamics, that gold and bonds are not a one-for-one replacement because of the volatility dynamics.
That's a very good point. I think that's a great way of ending that conversation, Adam. Fantastic. Yeah, you shared such great insight. I love having these conversations about markets, the macro side, the market side, and then how it really impacts portfolios. So investors, other financial advisors have a better idea of what's going on out there, and so they can create better outcomes for their clients. I like to end conversations with a fun story. Anything interesting out there, Adam? You're saying it could be market related. It could be anything crazy going on in Vegas. Have you been to the Sphere before yet?
Yeah. I was just about to bring up the Sphere. If you've not had the chance to come to Vegas and enjoy the Sphere, you must do it. I was fortunate enough to see the U2 concert there. It is an immersive, incredible experience that you can see on Instagram and not fully appreciate. Everyone should make a point to come out and see a show here, because it is taking entertainment to a whole different level than we've ever experienced before.
That's awesome. How big, like how many people does it seat? Do you know roughly?
I don't know the exact number, but I would say it's probably in the 10,000-ish
Yes,
range.
is it more centered around like, concerts and stuff, or do you think they could do like more like sports oriented thing, or is it more concerts?
Well, concerts have been the main
Yeah.
component. They did have a UFC fight there last weekend that everyone was raving about. Just the graphics.
Yeah.
That one of the problems with watching boxing match or a UFC fight is that if you are in the nosebleed section, you can barely even see the boxing gloves. But
Yeah.
at the Sphere, they can make the boxers 150, 200 feet tall on the screen behind the
Uh,
ring, and everybody can see exactly what's going on. It's such high detail that you can see eyebrow hairs and eyelashes. It's incredible
well,
what they've been able to accomplish there.
yeah, I definitely need to go down there. I'm a big fan of concerts. And being in Tahoe, it's a short flight or even a decent drive. I was recently in New Orleans. First time in New Orleans. We actually during that time had a hurricane, and so I got to experience that also. But New Orleans, if you haven't been there, that's a very interesting city. I didn't really coming away from it, didn't really know how to describe it other than interesting. Bourbon Street was interesting. I was there for work, so I behaved myself. But so that's another city that I would probably go to if there was a big event like Jazz
Yeah.
Fest. Not sure I would go down there just to go though.
Yeah.
But awesome, Adam. Thank you so much for coming on the show. I really appreciate it. Where can our audience get more information about Hightower Las Vegas?
Easiest place is our website, www.hightowerlasvegas.com.
That's easy enough. Perfect. Thank you again. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch or listen to past episodes on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.